A warm welcome to you, my dear children. We meet again with the 7th chapter of Unit 9, Bank Account and Bank Reconciliation Statement. Reconciliation Statement. Well, when I said the topic, when I said the main lesson, I'm gonna start with this word. When I said the main topic, the title of the lesson, Bank Account and Bank Reconciliation Statement, I'll just start this session by saying this. We are going to reconcile the business bank account with the statement, the bank statement sent to the business by the bank. Well, when I say that, most of you might be wondering, so what is reconcile, and what is there to reconcile? What is the meaning of reconcile? All right, let's clarify that. Children, as you can see on the screen, it says bank reconciliation statement. All right, that is what it says. Bank reconciliation statement. That is what today our topic should be. Reconciliation. Now, you pay attention to this word. Pay attention to this word, right? Reconciliation. What is the meaning of reconciliation? What is it? Do you know? Well, some of you may know. But for the people who do not know what is reconciliation, for the students who are wondering what is reconciliation, so what is reconciliation? Yes, it's a simple thing, children. It's a simple thing. It simply means make two variables which are, varied, or factors which are different to each other. Make these two variables agree. Make these two variables agree. All right. Let's say some variables, two things, which are in different levels, right? You make adjustments to both these variables and you make both of these agree, equal. Let's say equal. Okay, that is the simplest word that you always come across. You always use that word in your subjects, school subjects. Equal. What is there to make equal here in this lesson? What is there to make equal? What are you going to make equal? Are you going to make them equal? Are you going to make the debit and credit equal? The two sides of the bank account? The debit side and the credit side? Well, you make them equal. That is what you do by balancing. No, that is not what we are going to do. Children, this bank account which we have been studying, this bank account which we have prepared several times in the previous sessions, this bank account depends on the transactions that you do, the dealings of you with the bank. It is prepared, the bank account is prepared by recording all the transactions that you do with the bank, isn't it? With the bank. Of course, yes, that is true. if you deposit money in the bank, that amount, that value is debited in the bank account. All right. If you take money, withdraw money from the bank account, credited. Those values are credited in the bank account, credited. Okay. So these are the transactions that you do with the bank. If you issue checks, more checks you issue, each and every one, you credit. More and more checks you issue, lower and lower your bank balance will be. So these transactions that you do with the bank, all these transactions are the factor or the main, how can I put it, main feature in the bank account. The transactions that you do with the bank. Remember, not only you, bank also records all your transactions. Bank too records your transactions, every transaction that you do, right? By recording all those transactions, bank also prepares a table, a statement every month. Yes, that is true. Every month, all your transactions are recorded by the bank and it is printed on a statement, and that statement will be put in an envelope, and that statement will be sent to you, the account holder, via post. That statement prepared by the bank, it is a computer generated statement, a printed one, maybe one A4, maybe few A4s, yeah, will be folded and put in an envelope. To your address it will be mailed, sometimes even an email. That is called a bank statement. All right, here children, in the textbook also a bank statement is shown in your textbook, but this is not a real bank statement. This is a statement which is, a sample which is given in your textbook. You get my message? You get what I'm saying? This statement starts with the opening balance which was there in your account in the beginning of the month. Yeah, the opening balance is the first item in the statement, and this statement closes or ends with the closing balance of your account. Closing balance of your account. Right? In between, they will record all the transactions that you have done. Right? With that picture in your mind, let's go through the text. You have already studied how the transactions are recorded in the bank account, which are carried out through the current account of a business. Yes, children. So as I said previously, as I mentioned, the bank account is entirely dependent on the transactions that we do, that is done, that have been taken place in between the business and the bank. Yeah, using those only we prepare the bank account. And the asset principle is used, that is something else, that is an extra point here. The asset principle is used when recording transactions in the bank account. When bank balance increases, when the bank balance goes up, bank balance increases, the bank account is debited. When the bank balance decreases, the bank account is credited. Yeah, asset principle. But when I said that the bank also records all the transactions when I said that, children, I didn't mention this point. They do not record the transactions the way or just like we do. Just like we record the transactions. They don't record. They record in a different manner. In the bank statement, I just few minutes ago I mentioned that recorded all the recorded transactions in the computer, in the bank, in the computerized system of the bank, they print it onto a A4 and fold the A4 and put it in a nice envelope, and that they send the statement to the business. You remember I mentioned that statement. It's true that they start the statement with the opening balance of our bank account, the money, opening money balance, and they end with the closing money balance, the closing balance of the bank account, and all the transactions in between are recorded. It's true, but not the way that we record in the bank, in our bank account, not using the asset principle. All right, you'll learn that. Okay, the first para tells about the bank account, children. Okay, the transactions should be recorded in the bank account according to the double entry principle of assets. The transactions which increase the balance are debited, and the transactions which decrease the balance are credited. Simply what we have learned, right? What we have learned when we prepare the bank account. Same things, right? Yeah. Okay. But now check out the paragraph below this one. Now let us study how transactions are recorded in the books of the commercial bank. How the same transactions are recorded in the bank. How the same transactions are recorded by the bank. Now what I said earlier is going to be explained. Okay. In the books of a commercial bank, children, in the books of a commercial bank, books of a commercial bank, okay, they also record in its own books the transactions of the business are recorded. The bank also records in its own books the transactions which are done by us, which are done by the business. Not only our business, the transactions which are done by every business, every person who is having current accounts. All the business transactions done by the account holders, they record separately. All right. So it's a big process in the bank, what they do. The account that is maintained by the bank is treated as a liability. Is treated as a liability of the bank. You get what I'm saying? I'll double underline this. That is what you should learn here. Now, children, although we consider our bank money, our bank balance as an asset, of course it is an asset. It is our money. That is our money which is kept in the bank. Of course it is an asset. So the bank account also is considered as an asset. But bank does not consider the others accounts which they hold in their bank. They don't consider those accounts as assets. They consider those accounts as liabilities. That is what it says. Okay. the account that is maintained by the bank of the business is treated as a liability account of the bank. That's what I all this time I was trying to explain to you. That's what I have been trying to explain to you. This factor. I hope you understood. Because children, although the asset of ours is considered by us to be an asset, because it's our money, it is considered as an asset. It's considered as an asset to our business. Our money is not bank owned money. It is not bank money. So the bank treats our money as liability. They are holding on to somebody else's money. All the banks, that is what they do. That is our money. You get it? So it is a liability for them. Then all the statements that they prepare for all the current accounts that they hold, all those statements are prepared on liability basis. That's right. Okay, that's what I have been trying to explain to you. Therefore, the bank records the transactions according to the liability principle, which means liability principle is, what is the liability principle? Liability increase, credit. Increase, credit. Decrease, debit. So it is the opposite of our bank account, which is prepared by us. When bank money increases, we debit. When bank money decreases, we credit. But the bank, they prepare the statement by doing decrease debit, increase credit. All right, increase credit. It is the opposite to us. Okay, let's look at a bank statement which is sent by the bank at the end of every month. Okay, this is a bank statement, children. Well, this is accordingly a sample only. Okay, sample which is given in the textbook. But a real bank statement is given on the next page. There you go. This is a real bank statement. You look at this text. Let's read through the text, children. Usually banks, and you have to read. This is in your textbook, so you have the access to look at this while I'm doing the lesson. Yeah, take out your textbooks. Right? You have the textbooks, right? Usually banks send a statement called a bank statement. Usually banks send a statement called the bank statement. Right. To their current account holders once a month. Yeah. The bank statement shows, see, the opening balance. Opening balance. This bank statement starts with the opening balance of your bank account. Your bank account, my bank account, whoever it is, the current account. The statement of the business current account is sent by the bank. That statement usually starts with the opening balance of the current account. Just like we start our bank account with the balance brought forward. Just like that. Just like that. We start our bank account when we prepare bank accounts, children. Now we have prepared a few bank accounts. No, We have prepared a few bank accounts now. Yeah. When we prepared all those bank accounts, we started our bank accounts with the balance brought forward. Can you remember? We started our bank accounts with balance brought forward, or BBF. Yeah, BBF. Yeah. Just like this, right? We started with the BBF. The debit side of the bank account. On top of the debit side, we recorded the BBF, balance brought forward, BBF, here. Yeah. Just like that, even the bank statement sent to every business by the bank starts with the opening balance. The balance or the money which was remaining in the account when the month started, at the first day of the month. The money which was, carried forward from the last month, the remaining balance of the account. From that BBF, just like this, the bank statement also starts with the BBF, balance brought forward, or opening balance. Okay, right. And items which are debited and credited, that means the transactions that we have done during the month are debited and credited during the month, children, from the 1st of the month until the 31st of the month, right? All the items are debited and credited by the bank. Okay, and finally, the bank statement also comes at the closing balance. It comes at the closing balance. We're talking about the bank statement, right? Closing balance comes at the closing balance. In a sense, children, what I mean is it comes at the closing balance. What that means is the final remaining balance of the bank account. That is the balance carried down that we calculate in our account prepared by us. The final balance carried down, the closing balance, which is calculated by us in the bank account that we prepare by balance in the bank account. That final balance is also calculated by the bank in their statement. Okay. You get it? All right. So finally, after all these stories, I will ask you this question. I will ask you this question. This question, simple question. If we from the business by us, if we also prepare our bank account starting with the opening balance of the account, and we also record all the transactions done by the business as debits and credits, if we also do that in our bank account, and if we also finally balance the bank account and calculate the closing balance at the end of the month, and if the bank to do all these things, the final balance of the bank statement and our bank account should be the same, isn't it? The question is for you. Question is for you. You provide the answers now. Just say yes or no. Just say yes or no. What do you say? I'm just asking you, children, if the bank statement is prepared by the bank and the bank account, the bank book is prepared by the business, by us. If both these documents, the bank statement and the bank book prepared by us, if both these statements, both these accounts start with the same balance, record the same items and calculates the same ending closing balance, the closing balance of both these statement and bank book should be the same, isn't it? Yes. Answer is yes. But most of the time, when we who are in the business as accountants or bookkeepers, when we get the bank statement, children, it's disappointing to say, when we get the bank statement from the bank at the end of the month, most of the time, when it's compared with our bank book, the final balance, the ending balances differ. They are different. That's when we need to reconcile. That's when we need to reconcile. What are we going to reconcile? The business bank book final balance with the bank statement final balance. We have to adjust both these and we have to reconcile. Make them agree. Yes, make them agree. We have to adjust and make them agree. Well, that's it. That's it. That's what we do. All right. Let's do it. Let's learn how to do this. Preparing the bank reconciliation and doing the reconciling. Okay. First of all, children, there is a bank statement. This is a bank statement. A sample bank statement. This is the statement which is sent by the bank to every business, to every current account holder. Yeah, they send this bank statement through post. Yeah, through post. Okay. Sometimes nowadays they email the bank statement to every business, and to every account holder, bank current account holder. But there are most of the businesses, there are instances or occasions where the business requests the bank not to send emails but to send the hard copy or sending the printed copy via post. There are instances. Most of the time businesses they request from the bank, please send us the statement through post. If you email also, it doesn't matter, but send the statement printed. Okay, just like this. When this comes, we compare this statement with our bank account. We have also prepared a bank account. No? Yes, we have also prepared a bank account, bank book. I'm talking about the bank book. And we compare this statement with the bank book prepared by us. We compare the opening balance. See, this is the opening balance, children. This is the opening balance. Can you see the opening balance? Is it too hard to see? Yep. There you go. This is the opening balance. Okay. That means the balance which was brought forward from last month. The money which was in the account when the month was started. That is brought forward from 31st of July. Can you see the date, children? Can you see the date? Can you see the date? 31st of July. See, coming from the last month end of the last month end. This balance is brought forward, which means the money which was remaining in the account when the month finished, last month finished, that money is brought forward to this month. 34,654. Okay, 34,654. That is the balance brought forward. But notice this. Notice this. Now I'm going to show you something surprising. What is this? Right. Did you notice that? Did you notice that? It says DR. DR. 34,654 DR. What does this mean? What does this DR mean? It means debit, right? DR means debit. Yeah, of course. What else? DR means debit. Of course, yes. 34,654 DR. 34,654 DR. So debit balance, just like our bank account. See, just like this, debit balance. Debit balance. Balance brought forward to the debit side, DR. Isn't it? I'm asking you, isn't it? It's a positive balance, debit balance. Money remaining 34,000 something, or whatever the amount which was in the bank statement. The money remaining. How much was it? 34,654 and 10 cents. DR. I'll just write it here. 34,654. Let's forget the 10 cents. Forget it. Just no need to think about the 10 cents. 34,654 DR. Debit side. That's what the statement shows, right? DR. See? All these balances are DR. See? Okay. Alright, so that's it. DR, debit side, that means it's a positive balance. Now we can go ahead with the remaining balance brought forward from last month. We have 34,654 in our account. Alright, okay, let's go to the next one. Second transaction, third, fourth, fifth. There's a lot of transactions, right? Just let's check the second one. Check the second one, children. Second transaction, this one. Okay. Cash deposit. Cash deposit in the receipts column. Cash deposit. Okay. Cash deposit. All right. Okay. How much? 13,000. Cash deposit 13,000. That means we have put money, we have deposited money in the bank current account, which increases the balance. All right, let's see how much is increased. Cash deposit 13,000. Cash deposited 13,000 means, yes, of course, the balance should increase by 13,000. Oops. Did you see that? Do you see this, children? Do you see this? Has the balance increased now? Has the balance increased? No. No. From 34,000, balance has decreased. Decreased. The balance has decreased. See? From 34,000, it has decreased to 21,000. 13,000 decreased. How come? We deposited 13,000, so the balance in the bank account should increase. By 13,000 it should increase. But opposite has happened. It has decreased by 13,000. 34,000 has become 21,000. 34,000 has become 21,000. It's not wrong. Is the statement wrong? No. Children, my dear students, as I told you, children, the bank always records our money which is deposited in our bank account, which is deposited in their banks. Our money which is deposited in their banks. Banks are not ours. We are general public. We are the people. We deposit our money in banks. Banks are not ours. The money which we have deposited in their banks, those parties, the banks, they consider that as a liability. All right, as a liability. So they record according to liability principle the money which is in our bank account. According to liability principle. According to liability principle, liability increases credit, liability decreases debit. Okay, liability increases. What is the liability principle? Liability increases credit, liability decreases debit. Okay, liability balances come to the credit side. Credit side. Liability balance always is in credit side. Yeah. So if we have a balance in our account, it should be credit in the bank statement. But here it is debit. See, DR means debit, which means we don't have a balance in our bank account. This is an overdraft. This is an overdraft. This is an OD, the account of this business. This statement which is in this branch of the bank. This statement, this bank account which is in that branch has a debit balance, which means it's a overdraft. The account is overdrawn. From the last month, there is a negative balance, no money in the account. 34,654 overdrawn. Bingo. That's what has happened. Okay. So when the business deposited 13,000, here, okay, deposited 13,000 here, this overdraft got deducted. That means the bank deducted the 13,000. They took the money and the overdraft was lowered by 13,000. Okay, more money they deposit, lower the OD will become until the OD is fully paid. All right, just check the next transaction, children. This one, this is a payment of a check payment of 39,000. Okay, so when there was a OD still remaining in the account, OD still remaining in the account, an OD of 21,000 now. Okay, another payment was made. Another payment was made, a payment of 39,000. A payment of 39,000. See, balance increased. What balance increased? OD balance increased again. The OD of 21,000 has become 60,000 because 21,000 on top of 21,000, another 39,000 payment was paid by the bank on behalf of this business. So the OD given by the bank increased again, right? If we take the next transaction again, this one, cash deposit, it's a deposit, right? Oh, that's great. It's a deposit. Finally, it's a deposit. The business has deposited 10,000 to decrease the OD balance, and the bank has deducted it. See, 10,000 deducted. See, 10,000 deducted, and the OD has become, from 60,000 it has become 50,000. Likewise, children, studying the bank statement is very important. It is unquestionably important because in a past paper, very recent past paper, this statement was given to be drawn by the student. I mean, the paper had a question to draw a bank statement. How's that? So, if you don't know how the statement works, how the statement is prepared. Yeah. All right, children. With that, the studying of the bank statement, I'm going to finish the studying of the bank statement. All right? Studying of the bank statement. I think this is enough. Do you remember the things I said? We forgot something. Is this the same format as the bank account that we prepare? Is it the same format? No, this is not the same format. This is a different format. See, description column is there. A description column is there. See, this is the description column. See, this is the description column, children. Description. See, this is the description column. All right. Okay, this is the description column. And date column is there. Okay, date column. You see the date column? Date column is the first column. Description column is the second column. Okay. Right. Okay. Date column. Description column. Okay. Then remember this. You remember this, huh? Remember this well, very well. See, the two columns for the amounts are named as payments column and receipts column. These two columns are named as payments column and receipts column. Do you see what I'm talking about here? See? Payments column and receipts column. Children, these two columns, payments column and receipts column, these payments column and receipts column are considered as the debit and credit sides. Okay, let's mark them. Debit column and credit column. This is debit and this is credit. All right. Just for your remembrance, just to memorize, I'm giving you this. Okay. Payment column and receipts column. That means the payments that we make from our current account, all the payments are debited. And right hand side, credit side, receipts. Receivings are credited. It is the opposite side. It is the opposite of the way we do. We debit the receivings and credit the payments. Right? So that is what I wanted to clarify. I wanted to clear out for you. That is what. The debit and credit sides are opposite to our bank book. Opposite. If I highlight this debit column, see, debit side is for payments. When you pay, in this statement, some payments I can highlight and show you. See, this is a payment, children. It's a payment, 39,000. It's in the debit side. There's another payment, see, 20,800. It is also in the debit side. All the payments are in the debit side. Checkbook charges, another payment. All the payments are in the debit side. So cash going out are debited in the bank statement. Remember, okay? Cash coming in are credited. Cash coming in are credited. Deposits are credited. Deposits are credited. When cash coming in, see, these are deposits, credited. These are deposits, credited. All right, all the deposits are credited, 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 credited. All the deposits are credited. Okay, and after each transaction, after each deposit, the balance should be shown. After the deposit, the balance. After the payment, the balance. This format is called the running balance format. Running balance format. This is not the format we use to prepare our business bank book. This is not the format we use. But this running balance format is used by the bank to prepare the bank statement for each and every current account. Each and every current account bank statement looks like this. All right, children. The bank statement, as shown here, gives you a better, clear idea because, see, this is clearer. Balance is shown in the balance column. Then cash deposits are credited and cash payments are debited. Get my idea, right? Debit and credit columns, they come like this. Debit and credit columns. Debit and credit columns. The description column and the date column here. Likewise. Okay. Shall we move on? We can't be talking about the statement, right? Now, the final part, the final part about the statement. Final part is, children, this is the final part. Final balance of the statement. The final balance of the statement. This is the final balance. This should be the same balance. This should be equal to our bank book final balance, but it's not always the same. That's when we have to reconcile the reconciliation means reconcile the bank statement final balance with our bank book final balance. The bank book that we prepare, that also has a final balance of the BCD. In this month, the bank book BCD should be the same, the 10,750. But if it is not the same, we have to do a reconciliation. Okay, done. This whole paragraph tells about the scenario that I explained, right? I'll just skip the paragraph to the final sentence. The reasons for the difference between the final balance of the bank account and the final balance of the bank statement. Now I'm going to add some words to it. It's better if I can move this way so you can see clearly. What are, I'm just going to add these two words. What, W-H-A-T, what are the reasons for the difference between the final balance of the bank book. This bank account means bank book. Our bank book. And final balance of the bank statement. What are the, I don't know. Do you know what are the reasons? We are going to find out. Okay, and we are going to rectify, adjust, and do what is necessary to make the balances equal. Okay. All right. Children, this is the base of bank reconciliation statements. The base, the root cause, which is the reason to prepare bank reconciliations. The root cause I explained to you, right? The best way possible. Now you know what bank statements are. Now you know how bank statements are prepared. How bank statements are prepared. Who prepares bank statements? And how the final balance is different. How the final balance is different to our book balance, the bank book balance. Okay. With that, children, we will end this session. In the next session, we are going to prepare the bank reconciliation. We will prepare the bank reconciliation, and you're going to learn what things are necessary to prepare the bank reconciliation statement. So we'll meet very quick again with the next session. Until then, thank you for getting together with me. I hope you learned something. Hope to see you soon. Thank you.